Hey, what's up, everybody? This is episode 25 of Beyond the Edge, brought to you by Edge Investments. We got the full house in here today. Declan's wearing a suit. We just pulled him out of work. I didn't even know people still wore suits. That's a thing. Hey, I've got all mine collecting dust. Pete's sitting in the darkness. Toronto's been cooling off, and I'm just getting directly beamed by sunlight. So I'm in the hot seat, quite literally. And we got a lot to talk about today. We're talking about Air Canada. From an investor's perspective, they're going through a big strike. We're also going to talk about some recent tech IPOs, Figma, Circle, Klarna. And finally, why am I drawing a blank here? U.S. housing. We talk about Canadian housing a fair amount, but we want to talk about some of the American stuff. It's a little more exciting down there right now. So I'm not going to do too much of a preamble. We got the full team here today. Let's just jump into it. Air Canada. So we know there was a strike. It was probably the world's shortest strike on record. I think they were on strike for like 12 hours before the government demanded they go back to work. This has a lot of implications for an investor. So Declan, Mr. Fundamentals, I'd like to kick it off with your point of view here. Airlines, what's the famous quote? The fastest way to become a millionaire is to start with $1 billion and then launch an airline. What do you think about the airline business? What do you think about Air Canada?
No, I think it's one of those that it's a necessary piece. The strike stamp, ultimately employees are going to push, and when you have a union, you have an opportunity to advocate for yourself, find better rates, and in this case, it was a lot to do with how they were being compensated when they weren't actually up in the air. So I think that's obviously a good piece. Now, as you said, overall, the airline industry is a very, very tough business to operate successfully in. There are very few airlines out there that operate at a profit. Air Canada happens to be one of them. And so that kind of puts it in a unique position compared to many of its competitors where, in fact, it has some flexibility to actually kind of navigate these short-term uncertainties that other airlines may not be able to face.
Yeah, fair enough. And Pete, talking about just overall, unionization, what kind of precedent this might take for what this might lead to other airlines. What are you looking at? Like, what's the trade here? Like, how are you seeing this?
I think this was a huge step forward for what the airline flight attendants were able to do to get grounded pay. I mean, it hasn't been approved yet. They are going to vote on this. So they are still kind of, working in kind of promise of a new deal. But I think this is completely shaking up an industry norm that flight attendants were not being paid until the planes pushed back. Now, I think it was interesting as maybe I dug in a little bit more that the airline's position on that is that it is basically an admin nightmare to track otherwise, which might have been the case probably in the 90s. But I think nowadays you can get pretty accurate time on what time people checked in or maybe scan them or have some type of hourly pay. But they said it was basically an industry-wide kind of norm, which I believed. And they were then, incentivized with higher hourly rates that took in those delays into consideration from time to time. So that is beginning to change with, I believe, kind of the initial thing they agreed on is 50% rates from the time they step on the plane, which seems, a little bit fair until I heard that, that their rates were otherwise adjusted. So I think that's really interesting. But I do think kind of in terms of unions, like you said, that is some issues with collective bargaining. I don't know. I mean, I think unions obviously protect a lot of people's rights, a lot of ability to, get rights given to you, employee rights that you may not have otherwise got that you get in the power of those numbers. But it also, as, a business owner myself and a CEO myself, it's interesting because it caters to just service. Like generally your raises and a lot of things that are given to you are just by putting in the time, not necessarily being the best at your job, which is, I don't know if that's what I would want with my employees. Generally, I like to reward them on merit and over-delivering for that promotion.
Meritocracy, that's so old school, isn't it? It's not about being good at things anymore.
Yeah.
I mean, my mom was a teacher forever, and she would tell stories of some teacher, didn't have to tell me stories like, in high school, I saw it firsthand. Some teachers that you can just tell don't want to be there, do not care, bare minimum effort, but they've been there forever. So they'll always have their pick of the litter in terms of like schools and classes and all that. But it's simply because of their hierarchy. So doesn't always, great that it protects people, but does not always lead to the most positive outcomes in terms of like performance. And like you said, as a business owner. And it's funny. So Canada's a very unionized country. I think generally speaking, public, you don't, I guess it depends. You see previous strikes, public's not always that supportive because generally it's a pain in the ass when this happens, but this was different. Public support for this strike was like overwhelmingly high.
Yeah.
And I think, I don't know about you guys, I had no idea flight attendants weren't paid for the time on the ground. Like, did you guys even know that?
I did, yeah. Like I said, but I didn't realize the other part that, Air Canada stance. One of my good friends' wife is a flight attendant, so I kind of heard, maybe some things over some stories over the years, and just overall understanding kind of the airlines in general. Yeah. I think what is interesting though is during the strike, it didn't seem that shareholders cared that much. It didn't really hurt it too
It was
much.
like what, $1 drop on the stock, something like that?
Losing an absolute ton of revenue every single day that you're grounded. But I think they equated it to no much worse than like a snowstorm that would have happened in Toronto where things get grounded for a couple of days.
Yeah, I heard that exact quote saying that, there's snowstorms that have, intervened longer than this strike. Declan, does this like, sell off? I don't know if you want to call it that. Is
well,
this
I mean, the
is this like a
valuation
value
isn't
play
too
now?
bad
Are we
here.
interested?
Like, we're looking at a sales of about 3 and price to income of about, let me see here, 5, I think it is. So, when you look at it from that standpoint, I think it does look attractive. But again, it's just ultimately like factoring what the economics of this industry are all about. It takes a lot of money to not only maintain a fleet, but purchase new planes. And then on top of that, when a large majority of your workforce is part of a union, again, there's just an extra element that you kind of have to navigate. And I think that's why the market has continually factored it at a lower valuation than perhaps what it deserved. I mean, they generated $22 billion in revenue, but they only have a $5.8 billion market cap right now. So you can see that clearly the market is aware of these certain economic characteristics. And then it's just one of those things, as you said, there's a small little blip in terms of the reaction to the overall union. But I think, again, to Air Canada's benefit is their financial position. They do have about $11 billion in debt, but they also have $6 billion in cash. And so while a few days where you're losing significant revenue and you got to continue to operate and ensure that your fleet is well maintained, that is going to take a bite, but it's not going to be detrimental to the point where you're panicking. If you look at other airlines, it would probably be a much different story where they, without that cash position, may be on their last breath in just a few days as is. So I think it's a different perspective. Does it make it more attractive as an investment? I don't necessarily know. I think it's just my personal stance that the airlines are a tough industry to grow and build that sustainability. So that's my standpoint from an investment.
What if you remove all your competitors but one, and anytime you mess up, the government's going to bail you out? Does that change your opinion on it? Because that's pretty much the history of Air Canada. They have one real competitor, and anytime they're about to fail, the government picks up the tab. How do you think?
Or if a new low-cost competitor launches, they'll just launch their own, wait them out for a couple of years, and then jack prices up.
Because we have incredibly non-competitive pricing for flying in Canada. I think, especially within Canada, because it's only domestic carriers that service those flights. So that's why it's wild. They have to be competitive. I'm flying to Italy tomorrow on a very competitive rate that would have cost me, slightly less to go see Kev in Vancouver.
I was just going to say, I'd love to come visit you guys more. I think I haven't flown out to see my brother in Winnipeg for years because it's the same price as going to Hawaii.
Yeah.
Sorry, bro.
Well, but they have to be competitive on those rates because there's Alaskan Air probably goes Vancouver to, Hawaii or something along those lines connecting. I think that's the interesting part. You see these super competitive rates for Air Canada flying to Europe or other places, and then just our own national flights are outrageous. Yeah. I will say it's a big country though.
Yeah, well, just to jump in there to that point, that is a great highlight of kind of the monopoly or a really powerful market position that they have within Canada and even internationally. Like the Air Canada brand is pretty strong. I think it comes down to me like two things. First is, I kind of brought it up last time, but what are my top 10 prospects in the market, including companies that I already own? And then where does Air Canada fit within that top 10? And do they at all? And in this case, I would argue not. And the reason is this, my second point is really, I find that investing comes down to two things. One is the quality, two is the price. Right now, the price looks attractive. The quality of the business itself is pretty solid. But again, those economics within this industry really cap how much growth is attainable by any of these companies. And again, you have these very costly tangible assets. Like I believe a new plane costs anywhere between $35 to $40 million. And then on top of that, you have to ensure that it's consistently maintained, safe and meets regulatory requirements. You got to fuel it up, all these different things that limit its ultimate growth and how much cash it can retain. And it's just a comparison. Again, like they have a net profit margin of, I think it was like 6% here. Whereas you can look at a lot of software companies that might be pushing upwards of 40% profit margins, have very little debt, and can also have a cash pile that just can be deployed at any, like whatever at their disposal. So I think that's where it's a solid business. It's definitely top in its industry, but you just have to compare it to those alternatives out there that are beyond this industry itself.
Mm-hmm. I wanted to dig into the kind of the government's involvement in this, because they're using this Section 107, which is like, it's not back to work legislation, because as that name implies, they actually used to have to pass legislation to force these unions to go back to the work, or at least to go to arbitration to like try and cut a deal with an intermediary. But what they're doing now, it's a Section 107, which is basically like a minister just needs to say, we want this to happen. And they can overrule what's essentially your charter. It's like a charter right to strike, right? So they can overrule it. And they used it after 12 hours, which caused all kinds of concerns. And the Liberal government under Trudeau was like very trigger happy in using this. They used it numerous times.
Mm-hmm.
It turns out, like I said, a minister just has to say, get back to it. And that's all that's required. What's like unique in this situation is that Air Canada, the union, is just like, no. I think the head of QP was even like, I'm willing to go to jail for this. I guess he's got to earn his member dues. Yeah, but like, is it an overreach of government power, or is it like a necessary move to maintain, movement of critical goods? I don't know. But it's debatable.
It's a weird one for me on how it would be enforced, right? Because you're like, everyone go back to work. You're like, no.
No.
I'm just not going to do that. Like, I don't like what I'm getting paid. We have freedom of, labor in this country. I'm just not going to do that. So that was interesting to me when I saw this. Now, I get a bit of the government stance that there are a lot of important things that move on Air Canada planes, not just people on vacation. There could be, an organ transplant. There could be vital, medical materials. There could be actual, a ton of doctors have to fly in for surgeries. They don't live in downtown Toronto. They come work twice a week on the days they operate and fly back somewhere else. I know people that do that. So there is a lot of things that have to move around on these airlines, even though we think they're just commercial airlines. They do make money shipping things. They ship important people, goods, materials, all of that. So I think there was probably something along those lines that the government had to come in and say, okay, like this is a really important, vital piece of infrastructure. But then if I'm on the QP side, then I'd be like, yeah, then pay us like we're that vital, because you're not kind of treating us. So pretty interesting. I don't think any of us really love some government overreach in these cases, but I can understand it a little bit more.
Yeah, I would just say,
fair point. Declan, you have any final thoughts?
I would say Pete brought up
a
great point in terms of just understanding the importance of it, and you don't realize it until the employees are gone or the service is no longer available to you. So that is what these strikes are about in some sense, is to highlight how important and fundamental they are. Now, as you said, overall, I would say generally less government intervention is probably ideal. Let the market solve itself. And in this case, it's kind of unique because it is a private corporation with shareholders, whereas, say more public enterprises, whether it's healthcare or school districts and the like, it is a different scenario where now the clock almost ticks in some sense faster, because shareholders are going to continually be putting pressure and being like, what the heck's going on? Come to a deal. And ultimately, you want to compensate and reward your employees fairly. But as you also brought up, Kev, meritocracy is an important thing, and you want to be able to position it so that people are incentivized in a way to continue to produce better and better service. And so that's where I think ultimately, like, this is a big test for Air Canada. Is this the right solution in the long run, or did they just rush this and try to get a deal so that they could get business back on the wheels?
I mean, I don't know. And you're right. It's like, yeah, there's public companies, there's private companies. Air Canada is probably somewhere in the middle because, like, yeah, it's a private company, but then it has this massive government backstop.
Yeah.
Has a huge government protection in terms of like competition. And then didn't they even get bailed out at one point? Like they were going under and government.
A couple times. They've
more than once even
before. Yeah, government came in. The most recent time was 2020, where the government didn't want to come in fully as debt. So they actually issued kind of a new share class for them. I'm not quite sure if it was convertible, but they did get shares and they took a large equity position.
They own shares.
They did, and they have since sold them. And our government made a tidy profit. So that's one back for the taxpayers. But that was during 2020. They were done, right?
That was wild.
You know, the one thing I will say, I know we don't want to switch gears, but I'm probably not going to get to speak much on data in our next topic. And it wouldn't be a podcast if I didn't say that word 100 times. Speaking of,
if you can make this about AI, I'll be impressed.
We'll see. No, I thought what was most interesting is actually in 2020 when a lot of these airlines had to open up their books because they were grounded and they had to go secure a bunch of debt and they had to value certain parts of their business. It was wild what the loyalty programs got valued at, which made me realize that these are just, flying data points. Like that's where a lot of value is on airlines these days. And I can read them out to you. These were as recent as 2023. Delta Airlines Sky Miles loyalty program was valued at $27.9 billion. So yeah. And I'm looking actually at Aeroplan 2023. The actual loyalty program was valued at $6.8 billion. So that's how these guys were actually able to secure a lot of debt, was off of these loyalty programs. So I think that's really interesting that the loyalty programs value, how much is that worth, and the data sharing that happens, where if you're an Aeroplan member, you see that, all of a sudden link it to your Starbucks, link it to Uber, link it to now the LCBO and all these other areas. Again, data. I'm not going to link it to AI. But I think the data play there is really interesting as someone who kind of keeps looking at that, because I know, Declan, you were mentioning the price of planes. If you look at any of their balance sheet, these airlines don't own the planes. They all lease them. There's kind of two really
big I think JetBlue might be the exception to that.
That they buy their own. Well, especially they might do a lot more narrow bodies, which are a little bit cheaper. But most of them are leasing them.
Cheaper.
Yeah. Well, I mean, I think also the advantage of the lease is you get much better kind of expense on your tax break there, right? Like you get to expense a lot of it. I have no idea what the amortization would be on a plane, but I imagine it's like
I wish I knew.
Yeah,
I wish I was that rich.
I'm assuming it's like, at least in Canada,
Drake.
It's probably 20 years. So I mean, you're writing off 5% a year of your plane that you just spent, $100 million on, and you only get to write off $5 million, and you got to pay a lot of tax on that. So I think there's a huge advantage to them leasing it. Now I'll stop.
Yeah. So it's cheaper to fly to the US than it is to fly to Canada. Speaking of the US real estate, how's that for a segue?
Yeah.
Trying a little too hard there, but we're seeing the US it's flashing some warning signs of a bit of a concerning market to come. But you could say the same thing about Canada, but it's funny there because it's like could not be two more opposite situations and reasons of why it's happening. Like the US economy is on an absolute heater. They're just crushing it. Their unemployment is at like multi-decade low. Let's just say that. Not the case in Canada. Their economy is booming. Their GDP per capita has been going up and up and up. Canada, the exact opposite. Yet, the reasons are different. Like I sometimes forget that the US, it's still a high interest rate environment right now. Like we forget that, or I forget that up here in Canada because it's fairly low cost. You could still say over the long run, it's high-ish in Canada, but it's like high in the US. So you got all these owners that they've locked in these mortgage rates. They're not keen to sell their house, buy something else, and lock into a mortgage rate that would like massively increase their monthly payment. So the amount of inventory is actually like not that high on the market. So you're seeing some warning signs there. Pete, before the call, you were talking about what I just said there, locking in mortgage rates. Do you want to dig into that a little bit more?
Yeah, I think that's a really interesting thing for our American versus Canadian kind of audience, is that the US has 30-year mortgages that people were locking in, low twos for 30 years in 2021. That doesn't necessarily move with your house, right? If you sell, you might have to get on a blended rate. So you're very much incentivized not to sell that house and all of a sudden, create kind of stricter inventories in the market, which I think is creating a little bit of upward pressure in pricing, and it might not necessarily be demand, because what's also kind of contributes to that is, their mortgage rates today on average are a little over 6.5%. Which is also then going to be affecting kind of the borrowing on housing starts. So it is becoming a tighter market overall, but we are seeing, I know in some of this data, Kev, if you're seeing the same thing, inventory is about 4.5 months across the country, which isn't terrible. So I'm sure market to market, it's very interesting. But I think those are some interesting points. What do you think? You're the real estate developer.
I mean, I can tell you, like in Canada, I don't know enough about the US other than it's so much quicker, cheaper, easier to build. And like you see Florida and Texas, like they had this insane COVID fueled real estate boom in 2020, 2021, something like that. And then they're even calling for a slight decline over the next few years. Like I'm watching Miami like a hawk. I still am toying moving back there, and I'm seeing they're actually expecting like a small decrease. But the reason is, it's so much easier to build and cheaper that a huge amount of supply hit the market. And guess what? All these people that are like, it's not a supply issue. Like, of course it is.
Mm-hmm.
All this supply hits the market, prices come down. Like that's simple economics. So, I mean, it goes both ways, right? In Canada, we can't build anything. It's so difficult. Guarantees the price pretty much goes up. The US market to market, it's so different. Like Mr. Fundamentals, do you have any view on?
I think one of the biggest takeaways, and you kind of highlighted it, Kev, is it really is a case by case basis. Whether you like looking across different states, they experience different situations overall. But as you normalize it and you average across the country, I think the biggest thing for me and my takeaway is that it is really tough to predict the market, because as you guys kind of highlighted, we were in a position where interest rates were near historic lows as is. Then COVID hit. Then they lowered them even more aggressively and near zero. And this led to a huge trailing influx of home buying that pushed the prices quite dramatically relative to what they have been. But as the Fed adjusted and the economy kind of cooled after all that stimulus money, it put in a situation where I really thought, okay, maybe people were too aggressive. Maybe they jumped on this bandwagon of buying these homes, and now that rates are going to shoot up, that the actual prices of the houses would correct a lot more than they did, and put people in a situation where now they were overpaying for their mortgage and not necessarily in a financial position to do it. But as you kind of see, somehow the U.S. economy has really not only maintained its growth, but is even continuing to push faster and faster in some regards. And this, I think, has kind of uplifted the overall economy as a whole, because, again, we can talk about U.S. government debt and how it continues to rise. And you think there's these cracks and you see all these things that you would consider. These are like very, very serious problems, and they very well could be, who knows. But they have managed over this course of time, say the past like 5 to 7 years, really been able to sustain themselves far better than I ever anticipated. I thought there was going to be a much bigger correction than what has happened. And really in housing, there hasn't been a correction at all for the most part. So it's kind of normalizing, going flat, but it's not necessarily on the downtrend quite yet. So there's a lot, but biggest takeaway more than anything is it is really damn hard to predict the market.
Isn't that
sure? Well said. I do think there's definitely some soft spots though. I think, Kev, if you're looking like in Florida, I think the panhandle's taken, a bit of a beating as well. There's a lot of things for sale on that side, on the Gulf side, very reasonable prices. but they have a huge, home insurance issue there, right? Like,
They can float on the coastline with the hurricanes.
And the type of coverage you're getting there is, kind of minimal. So I think they're going to have to figure something out on, maybe a state level of getting people to get their houses kind of insured, or maybe stop building, certain homes in the line of a hurricane that's going to happen.
I'll tell it to California too, right?
Oh my God. Yeah. That was obviously terrible. Or maybe just fill your basins with water. I don't know. That might help. But
you got options.
Yeah. I think when you're kind of looking at some of these natural disasters and really what it's going to take to kind of build back, and, government intervention probably has to come in to kind of look at what the house insurance market is going to look like in the future.
Well, glad you said that. So I got two things to comment on. So one, I'm going through a big insurance claim right now in Whistler for a flood. It's my first time seeing what the actual process looks like when there's a crisis. And it's just crazy because these insurance companies are so skilled and so designed to win these cases. And just because you have insurance doesn't mean your payout's going to be anywhere near what it should be, because they do everything from being, well, one, they're just going to be more organized than you. They know the policies inside and out. They know what documentation you likely have, what you've probably lost along the way. They know when the limitation date is, and they know how to drag their feet on getting you right up to the deadline, so that you can kind of miss your chance at getting a claim. It goes on and on and on. And you go down to California, like in the Palisades, all those people, they've been paying insurance on their homes for 20 years or more. And a year, 2 years before all these fires, their policies started getting canceled and these companies wouldn't renew them. And then all their houses burned down and they got nothing. So it can be like a really brutal, sad situation. But part of what happened in California actually was government intervention actually kind of had the opposite effect, because Gavin Newsom put in legislation preventing these insurance companies from increasing their premiums. And as a result, these insurance companies just said, hey, okay, well, we can't, it doesn't make economic sense for us to be insuring. Yeah. So they declined the coverage, which they're legally allowed to do. So, Mr. Good Guy is like, hey, we're capping the increases on these premiums. And then it ended up resulting in absolute catastrophe. Now, certainly not putting that on the government entirely, but I'm saying it wasn't a positive government intervention. So I could say that. So is it what's going to happen in Florida? It's like the exact opposite side of the political spectrum. How are they going to deal with it? Because they're going through, just like you mentioned, it's scary. Older buildings with the risks of hurricanes and stuff. Like, I would be terrified to buy something right on the water down there, even though it'd be a nice, pretty and nice place to kick your feet up. I'd be way too scared from an investment perspective. So I don't know what's going to happen there.
I don't see how there isn't some form of a collective tax that then partners with some government entity that partners with an insurance company to insure people, because insurance companies don't lose. Like their math, their underwriting. I don't know. I went to university where they had this huge school of actuarial science, which I had no idea what I was till I got there. And then I realized those were just the smartest people at my university. And then you realize they all get recruited by insurance companies like in third year. So wow. Yeah. There's a whole thing to it, how they actually map risk. I think it was did you ever see the movie Along Came Polly with Ben Stiller and Jennifer Aniston? He's an actuary, so he predicts risk.
Okay.
Yeah, so anyways, very neurotic character. Ben Stiller playing neurotic, I know. But these guys have all the math on risk kind of done, right? And they've tracked this stuff for years and years and years. So they know what the odds are on a claim, and they're there to make money. And then they pile that money away and invest it in other things like real estate. So it's an interesting business, but its impact on the housing market, and I think especially those two states, which you have to imagine, California and Florida are pretty big economic contributors to the United States, and people need to be able to live there and insure their property.
No, I would just say one final thing is just that you're kind of damned as a homeowner in some way, because you do need insurance one way or another. And like you said, Kev, too, the hassle of trying to actually get that claim it's always going to be as much effort from your end as possible in order to extract whatever amount. Now, you could open a whole nother can of worms about insurance businesses and the benefits of them, also kind of the twisted side of how the business model is structured. But I think it's one of those things that you need it one way or another. And so you kind of have to just play the game to some extent. But then again, maybe that's just exploring different markets and finding a situation where not only from a housing price standpoint, development standpoint, but as well as an insurance standpoint is optimal. Tough to say in Canada, but I'm sure just with the number of markets down in the US, there is a lot more flexibility and options out there to try and capitalize. Yeah.
Well, I just asked your best bud, Warren Buffett, right? He loves the insurance business. Wasn't that one of Berkshire's like first big plays was, maybe not first, I shouldn't say that, but it was a big play getting Geico and, the business model of collecting the premiums every month, investing it across his other assets so that he can make money while he's waiting to pay out claims and, the payoff.
Yeah, 100%. Look at Progressive and Geico. Both of them are fantastically positioned overall. And that's just it. You try to avoid high risk areas overall and then build a big float and invest that. And if you invest it at a high rate of return, like Mr. Buffett can do, you build a lot of wealth with free money to some extent. So let's do it.
Let's get in the insurance business. I'm down. Let's do it. I'm an expert
They
now.
pay dividends.
That's actually what I spent the entire day today doing, getting ready. I engaged a law firm because we have to sue the company because we've hit our 2-year limitation date. So I'm going to learn a lot about insurance. So
can we trash your provider? Can we say, or is that confidential now in your case?
I mean, I would love to do that. That would bring me great joy, but just somehow it just feels like the wrong move.
Yeah, I could
right
see
now.
that like somehow they have active listening and is going to be one of our 42 viewers.
Yeah. Oh God.
Yeah.
Oh well. So anyways, let's enough of this. Let's get back into tech. Because that's what we love talking about. It always winds up back in tech. So the IPO market, years ago we were doing the podcast and saying, I think anytime now IPOs are coming back, tech IPOs are coming back. And then I think Reddit went out. In my memory, it was like an okay IPO, and then it ended up doing fairly well after that. Yeah. Right. But we were kind of looking at these IPOs, just waiting for like, what's the first IPO that's going to like bring things back. And it seems like things are looking pretty good. I mean, we've got IPO flurry right now. Figma went out, doubled on the market there after doing a big raise. We talked about them years ago. I want to say 2 years ago, we talked about them on the pod when Adobe was trying to buy it. Circle did an IPO. Klarna's talking about it. So, I mean, I know you guys have lots to say. Pete, you got lots to say about Figma. Do you want to just dig into that first?
Yeah, I think how great their IPO did is putting me in kind of, we're in a bubble territory all of a sudden. And yeah, I mean, there is no reason they should have that valuation, in my opinion. I think it is really overvalued even at today's price, which it's in the 70s and I think around 35 billion market cap. Doing less than $1 billion a year in revenue with not a crazy amount of monthly active users. So, and I think significant risk for its future. I am incredibly bearish on this stock. I think it's a great tool, but I just feel the way the industry is going isn't actually with these like tools that are targeted to professional designers. If you're looking at like generative AI and vibe coding, it's actually democratizing that skill set. So I think they're in an interesting niche. At my agency, we're Canva partners. We don't really need to use Figma that often because of what's been going on with some of this generative stuff and what's been happening with Canva and their APIs and their automations. They actually had big Canva plug. Unfortunately, they're still private, but they had a really great slide at their partner day presentation. So as partner days, we got to go down to LA and meet the other partners before their big keynote. Really cool. But they showed kind of a representation of what they are. And they showed like an iPhone, right? And they showed the iPhone camera. And then they showed I'll just say some competitors maybe, or some other design places in the space, and they showed a DLSR, right? So there's always going to be a place for a DLSR for professional photographers, but then as a shareholder, wouldn't you want to be investing in the tool for the masses? That's my thought.
So Figma is like a really high level professional tool for design.
I think it's design professionals use it. Yeah. I mean, Kev, like you've seen some of my design skills. I wouldn't say I'm nothing, right? I know how to do it.
Solid.
Yeah, they're
solid.
okay.
Better than mine.
Someone sent me a deck on Figma like 2 days ago to look at, and it took me a good 5 minutes to remember how to export it as a PDF. It was just not that user friendly. So, and I'm not a
Canva's
boomer.
easy. It's beautiful.
Exactly. So I think it is great. I think it actually was an interesting sweet spot of, let's say, positioned in terms of design skills, like a little more technical, and you could do a little bit more with it for sure in terms of prototype wireframes than Canva. And you didn't have to be as technically adept as Adobe. Because like I remember starting out kind of in the creative world, you needed to go to school to learn how to use Adobe products. There was nothing like that intuitive about it, right? Like figuring out, like if you give it to someone who doesn't know what they're doing, like they're not going to figure out layers even and how to select things. Like you had to learn how to use Photoshop. You had to go to courses, tutorials where you could kind of get around with Figma a little bit easier. And then now Canva is just, if you can use a computer, you could probably design.
No, 100%. I honestly, like the biggest takeaway from what you said, Pete, and I think really any investor can learn from this, is if you are a consumer of these products and you use them often, that gives you a significant advantage in any market, in any industry as an investor, because you truly understand what they're used for, their pros and cons, and Pete did an excellent job of highlighting that overall. So taking that first and foremost, just the consumer perspective and the advantages and disadvantages, you can clearly hear that there are better alternatives out there, whether it is Canva. And I'll kind of shift my attention more to an investment standpoint is, again, Figma is competing not only with Canva, but as well as Adobe. And again, I'm not sure if it is the same today, Pete, but I believe that Adobe overall is still positioned as the market leader. I mean, the company does have $154 billion market cap, and they're generating over $22.6 billion in sales. So they're definitely in a stronger fundamental standpoint. But I think more than anything, this is a great example of if you know your product, if you know your investments, and that can be a consumer, a stakeholder, you operate in the business, any little advantage you can get to differentiate what makes a business good in this industry or not is going to be a huge advantage overall as an investor. So I just got to say props to you. I think that was a neat little coverage there of a company that I definitely would not have understood as well as you had. So,
oh, thank you. Yeah, it's definitely something we're pretty close to.
Well, okay, so let's look at this from. I was trying to quickly find out what episode we talked about it, and I can't find it. But we talked about the Figma. The Adobe was going to acquire it. It was for $20 billion. So actually, their IPO 3 years later was at like a slightly lower valuation. Mm-hmm. So they kind of had to like wait 3 years to stand still almost, and then obviously, raised money, and then the thing just went crazy. And anytime you see an IPO go crazy, you know that kind of sucks for the company because the bankers probably underpriced it relative to what the market's going to pay for it. And they raised money and accepted way more dilution than they would have had to had they been given a higher valuation. So kind of sucks for the company. I would be curious to know what kind of secondary sales happened at the same time. Like, I haven't looked at it yet at all, but if founders or insiders were selling around that $20 billion mark, well, they're probably furious because they could have sold it for way higher. But that being said, we know for a fact insiders would have been locked up for sure. So they're probably popping champagne and delighted at how this all worked out. Compared to selling for 20 billion, 3 years ago, time value of money, obviously you'd be stoked to have that money sooner, but I would be curious what the earnouts, what the lockups would have looked like. Did the insiders do better with this deal?
Yes.
I don't.
So
Yes.
I did.
I mean, we'll see what happens when their shares unlock.
Yeah, no, I mean, they are. I think that's why we're seeing it kind of go down. But if you want to take a look, Kev, you can kind of look at some of the lockup periods from the prospectus. A lot of it was only 180 days. So a lot came free.
Wow.
Yeah. So
That's nothing.
yeah. So that's kind of a lot's coming.
So then,
there.
they killed it.
And then you're looking at,
crushed it then.
yeah, they crushed it. If you actually look at the repricing of what the original price would be with some of their 5-for-1 split when they were kind of doing some dilution, the seed would have been priced in today's at 8 cents a share. Series A at 19 cents a share, Series B at 33, Series C at $1.09, Series D at $4.60.
And it's what right now?
Series E was their pre-IPO at $21, and it's in the 70s, and it hit 110 day one. There are some people out there that made absolute bank. There was a recent story of an employee that wasn't there that long that cashed out in $15 million.
Yeah.
From their options. So
see, when an IPO goes right, oh my God, that's crazy.
Yeah.
Especially options too. You don't have to pay for it.
Yeah. I think there is longer term potential for pretty big dilution. Their employee equity options were, there's 23.1 million Class A, full 800,000 Class B, 58.7 million RSUs for Class A. So, and these exercise prices around like $24. So yeah, I think.
Well, okay. So how about this? You think you're kind of a little bearish on it. You think that they're overvalued. We know that 180 days from the IPO, which was whatever, recently, we could do the math. Do you short this thing?
I never have the stones to do it because there's just, because there's just, I know there's like, we know institutional pros that know a lot more than us when it comes to shorting. So it's just not my game. But maybe, I don't know. That's not a bad idea. Like maybe I should check what's in the old margin account. Roll the dice.
Like, I mean, it just depends how overpriced you think this thing is.
Kev, you and I have a shared trading account. You wanna roll?
It's, oh God. I'm like you. Like I've never had the guts to pull a short just because like, okay, I'd feel a little more comfortable with a company like this. It's a huge beast of a company. Like we usually talk about shorting. We're looking at like penny stocks and like these guys. And I would just never touch that because we know how manipulated those things get. Like it's just not fair. Like your math means nothing because if a big, sketchy institution wants to come in and short you, they'll find nasty ways to make sure that stock goes down and vice versa if they want to prop it up. So it's just like too easily manipulated. Something like this, it's like, okay, we're like a big company. Like it's not a little tiny dinky thing. So logic does prevail at times.
Curious on maybe looking at the short report, getting closer to that time. But I mean, with something this big, I think you kind of get into that like billions territory, right? Like where there's some big personalities at stake that if they're putting a short on you, imagine you're an executive or you're the guys who backed this, right? And you have this great position at $21 pre-IPO and your fund put in $6 billion and it's hovering around 70 and buddy down the street on Wall Street takes a massive short on it. Everyone sees it. A bunch of other people short. Like there are conversations that exist between these two groups that, words are exchanged. And I think at this level, it's probably pretty serious heavy hitters. So that's why I don't do it. I don't work on Wall Street, but I think if you ever watch some episodes of Billions, like that stuff exists. That's probably like one of the more, obviously it's drama, but more real takes of some of the things that happen between the people that are actually controlling these funds.
Yeah. I mean, what was that other we were talking about? I'm looking up now over here. I want to figure out when we were talking about the DJT, the Trump media. And looking at that gigantic unlock that was coming. I was trying to like look right now and figure out the date. I say like April 2nd, 2024, we had a clip on it. So maybe the pod was just before that.
Yeah.
I'm seeing like some wild ride.
Some pretty crazy volume.
Yeah, I got to look, but it seems like from the 24th April down, like a lot. So I'd be curious to look how that would line up with the unlock. So I mean, that was a different story entirely. Like Figma's a lot more about real
Yeah,
of a company, I guess you could
they're
say.
definitely real, but at the end of the day, like you kind of know it as well as anyone, once you go public, there's a lot of other things at stake, right? And
Yeah.
especially when something flies like this, there's probably some interesting holders for sure.
Yeah.
And then speaking of interesting, yeah, who else is coming up? Uh,
Like in terms of IPOs,
yeah,
like
yeah, yeah,
Klarna coming
yeah,
up.
Klarna. Yeah, there's
Let's chat about that
yeah,
then.
nothing like financing your coffee, right?
I didn't get it. It's wild to me. Like it doesn't make any
I
sense that that's taken off, but like Gen Zs love it.
Yeah, like I was happy to dig into it a little bit more, but I want to hear Declan's take on this first.
Yeah.
Yeah. With the fundamentals of this business.
I mean, yeah, like the structure just seems like entirely flawed, especially like seek upwards of a $14 billion valuation. But the the micropayment structure, I think that there was a big positioning for the safe, or again, probably COVID hit, and then kind of the market took off for a while there. But you're just in a position where you are putting up a lot of liability in order to try and yourself, and you're hoping that these people that again trying to make payments on, say, coffee or any of these small, if you're arguably in a position like that already, you're probably dealing with some high risk already. So I think it's just one of those situations that if you are going to loan out money, you better have a lot of it be in a that can and tap in and really just endure any time of turmoil. Fortunately, the market has been in a good position so far. And again, the economy has not faced a serious correction, but the moment that thing flips, I don't know why. I generally, I don't think in like overall IPOs are a very tough investment to get into. And then the short side of it, it's you're playing with a lot of fire, like you guys have talked about, is it could just go up for any number of reasons, and you could be completely right on your analysis, your take, but the timing is off. And that's the same thing here. Is I would look at either one of these companies and be like, do they deserve their valuation? Probably not. Are they in a competitive advantage where they could, build a really enduring business? Probably not. There's a chance, but it seems unlikely. So those two takes right there, you would look at it and I would just immediately pass on them from that standpoint right there.
Well, the big beef that I have with the business model overall is like, the core revenue is going to be from like fees and penalties and things like that. It's just like such a shitty kind of like not exactly a feel good business. Like you're growing the world, you're inventing something, you're innovating, like you're just helping people dig themselves into like basically an alternative form of debt. And what a big kind of not controversy, but like a complaint is that people will finance so many different things that it can apparently become really hard to keep track of like your payments. And it makes it easy to like collect penalties and fees and stuff. And it's like, that's your way of driving revenue for the bottom line. Like just, I don't know, nothing that's going to make you feel too good at the end of the day. And actually, I'm going to have to eat my words a little bit here because I always thought of this as a Gen Z business, like through and through. But apparently their average age of a user is 36. And their biggest demographic, like that's growing, is boomers. So like I never would have guessed that whatsoever. Also doesn't make sense. Like you'd think the boomers would like know better or like have the money to do this. But I mean, does that just mean we're all like effed? Like, is this just like a leading indicator for the downfall of civilization? Like, I don't know.
It's interesting because I think they have a few different revenue models, right? One of them is the no interest payment, right? So I think if you're a boomer and you can divide this over, I think one of their core offerings is 4 payments. Well, why not, right? Money in your pocket today is worth more than it in the future, right? Time value of money. So on that side, they're not making money off their end customer as much as they are the merchant. So I think if you kind of look at,
Interesting.
yeah. If you look at accepting, so I have a business, maybe I'm selling these at mass, but if I take credit card, I pay let's say if it's online, I'm paying Stripe 3%, right? So I think Klarna is anywhere between 3 and 6%. So to me, to offer it to you and offer you my customer, I might not even be losing any money. I could negotiate as low as 3%, as high as 6% with them. So they're basically a merchant fee provider, which isn't far off from a credit card model. And, I think if we look at what's happened with the valuation of credit cards, like they've really gone through the roof over the years. I think even like only MasterCard probably went public in mid 2000s. Like when you think about that, that's not that long, and their valuations have really, really went up. And then I think the number two, is they will look at longer amortization periods where they do charge interest like a traditional kind of lender. And then number three revenue model is missed payments and fees, and then longer term lending, which I think they're at like 35% interest. So that's the part maybe I wouldn't feel good at as a shareholder. It's like higher than credit card rate. And so,
well, that's a good point though. Okay, so I was wrong about this. So generally speaking, you can charge it with your Klarna. You get 4 payments. If you pay it on time, you don't pay
no fees. And it's
okay.
kind of like
I didn't know
kind of
that.
like a credit card. And that's actually the majority of, that's their number one source of revenue, is actually people doing that. But again, like you said, most people are terrible with their personal budgets. If you do that 20 times, you're going to start forgetting that you have 20 monthly payments, right? Yeah.
So wait, do you sync up a credit card with Klarna, or does it kind of
you
act
sync it up
instead of your credit card?
I think you sync it up with your credit card.
So then the vendor would pay like a MasterCard fee and a Klarna fee?
I used it for
and they would
probably
still
a couple
want to
of years
do that.
back for an Airbnb once. And again, like the ease of being able to spread out the transaction was nice. And I think the big difference between them, well, there's 2 reasons. So first is they don't have the platform. They rely on other platforms and building those relationships. But at any point, if it's not turning out or working well, they could flip on a dime, take them off the platform. That's the big difference, where Visa and MasterCard, they have a massive platform and network, and it's that trust between when your credit card goes and it registers, say at a pay device, whatever, Square or whatever, and it sends that direct communication with your bank, and it confirms that, okay, this is a Visa or a MasterCard. So that's a major sticking point for the credit cards themselves. The other part of this is that with a company like Klarna, they're dealing with a lot of microtransactions relative to, say, what you would be doing with credit cards or banks or anything like that. And so again, if you're dealing with a payment that's $500, you may be making $5. Now, to be fair, you have a massive user base, and I think they do have 150 million users overall. So they certainly add up, but it's nowhere to the size and scale that a Visa or a MasterCard or even like something like PayPal is able to operate at. They're still at a significant disadvantage. And there's a lot of options out there. And not only that, but the platforms themselves can set up and position themselves to build their own method of making these buy now, pay later situations. So it's a lot of ways where they're dependent, and then how the scale of it overall is a lot smaller than their largest competitors.
Well, I'm gonna have to go finance my coffee.
Yeah, well, that's well said. By the way, if we're using, well, thanks, Declan, for all that. If we are using MasterCard as a, maybe comparable, they went public in May 26, 2006. They've definitely obviously done some splits, but in today's price, it would have been at $4.50 USD, and their stock is trading at $5.91 today.
To be fair, two of the best businesses though, like 50% net profit margins for both MasterCard and Visa. They have built a duopoly that is unmatched. Like, of all the businesses I have looked at, if their valuation wasn't so high, they are some of the best companies out there in the world. They have an international exposure, and then they just are positioned where pretty much everybody either takes Visa or MasterCard. It's an universal product that everyone uses.
Yeah, no kidding. That's true. I was curious, and I looked at, does a merchant have to pay Klarna fees and credit card fees? If you believe Gemini, it says no, merchant would not have to pay both the fees. They would basically choose one or the other. So do you have to like fund your Klarna account, like put money into it? Or, oh, actually, no, now that I'm thinking about it, because when you pay with Klarna, Klarna actually pays the full fee up front and then you pay them back. So yeah, I guess in that sense, they're totally replacing a credit card entirely. So, but man, that just sounds like a crazy risk to be taking on. For the kind of person that wants to finance a coffee, you pay for it up front and they pay you back.
It adds up.
That's terrifying in my mind.
Yeah.
Like, I mean, I guess you could say credit cards like the same thing, right? Because Visa is paying it up front. So I guess it is very similar. Ooh, I got a lot to think about on this one now. It's interesting.
So, you know what? Our conversation has made me slightly more bullish on it than before. I thought a lot of these were kind of like the doom of the economy, and I was just kind of looking at some other ones coming up. But I mean, what utility, what difference is it than a digital non-existent credit card for me as a user?
You pay back in a longer period of time.
Yeah.
I guess the 4 payments. Do you guys know how
Like
often, like Declan, when you paid for an Airbnb, if you have 4 payments, is it like 1 payment per month for 4 months, or how do they space it out?
And you may have summons of the timeline. It's still 4 payments, but it is, I'm pretty sure it was bi-weekly for me.
Okay.
So you get like double the amount of time to pay it back versus a credit card, I guess. So I guess that's the main benefit. Interesting. That's actually interesting. Yeah, it's funny. Our conversation is kind of like making me eat my words in a few ways. I think we might need to do a follow-up on this.
Yeah, I think we're gonna have to mark it. So, okay. I'm gonna have to look at the prospectus though, because I'd be curious what it does opening week.
Yeah.
I mean, I don't have enough to say what it would do, but if it's following recent trends, I could see this one going up opening week. Like,
yeah, that's interesting.
Yeah.
Can I buy my IPO shares on my Klarna account?
That'd be interesting. IR team, could you get back to us on that?
Yeah, right.
Yeah.
I'm sure there's no issue with that whatsoever.
Yeah.
Because stocks only go up. So
That's right. So I think this is interesting. I mean, hopefully, I think this timing is going to be a little bit more helpful for them, because they think they were going to go around April when the S&P decided to absolutely crater for five days. And they, I think that kind of called them off. I think this timing will be interesting for them. I think fall might be good. So I think this is definitely one to watch.
It is. Let's come back to this and do like a full dive. We're running up on the hour here, so let's wrap it there. But I think we know what our follow-up topic is. We're going back on Klarna. I don't know when the IPO is, but we'll be keeping a close eye on that. So for the 42 of you that are tuning in and listening, one of them being probably my insurance adjuster, thank you for tuning in. This is episode 25. As Pete told us, apparently 95% of podcasts don't make it past episode 20. So we're killing it, and we can pat ourselves on the back for that. We'll keep doing this. So we'll be back again. Thank you guys for tuning in. We got a full house today. We'll see you again next time.